The stock market has been pretty crazy given what's going on around the world right now. Many new investors are confused as to what stocks to choose. Today, I will be talking about 7 stocks that I think would be bullish as of September 2022. Kindly do understand that the stocks listed are not guaranteed to make you rich. It is still a must that every investor do their own research on the stock market. Hello and welcome to Investors Facts, where we address all your investment needs and questions. Stick around till the end of the video to learn more about investing and be one step closer to financial freedom you've always wanted. Tesla is our first stock today. Tesla is an American EV manufacturer. Tesla's share price is $288.09. The stock's 1-year price chart shows dramatic fluctuations. November, January, and April were high points this year. We saw a significant drop in May and solid rebound since then. Tesla's market cap is $300.907 billion, and it earns $35.48 per share. Their 5-year anticipated PEG ratio is 2.11, and their price-to-book ratio is 25.5. Their profit margin is 14.17%, and their return equity is 29.89%, which is strong. They made $67.17 billion last year. Tesla's stock split is optimistic since it shows the company's success. Tesla needs to lower its stock price to attract new investors is a great indication. And the company's reputation as an innovator in EV manufacturing has sent shockwaves across the auto industry. VU is the Vanguard S&P 500 Index Fund. This is an ETF that holds the top 500 U.S. firms. VU should be the first pick on the list. VU has a 52-week low of 344.24 and a 52-week high of 441.26. 1 year ago, VU was trading above $400. A significant drop in January and February, a minor rebound, another big drop, and a solid recovery since then. The 5-year-old chart shows VU's long-term growth. This ETF has $780 billion in assets. The average P/E ratio is 14.08, with a dividend yield of 1.49, and it's down 11 years to date. VU is a big blend ETF with a 0.03 cost ratio. This means the expenses to acquire this ETF are nil, making it one of the best if you're optimistic about the American economy. We are heavy in consumer cyclical financial services, healthcare, communication services, industrial and technology. Apple, Microsoft, Amazon, Facebook, Alphabet, Berkshire Hathaway, Tesla, Nvidia, and JP Morgan Chase make up over 25% of this ETF. Next, we have Apple. Apple makes smartphones, tablets, laptops, and operating systems. Apple has a market cap of $2.63 trillion and is currently trading at $163.62 US per share. P/E ratio is 27.04. EPS is 6.5 and dividend is 0.54. 5-year PEG ratio is 3.04 and the price to book is 47.03. The profit margin is 25.71% and the return equity is 162.82%. They have $48.23 billion in cash and a 0.87 current ratio. 14.71 is a respectable dividend payout ratio. The IT giant consolidated financial statement shows only growth. Apple won't just survive, it will prosper. Apple claimed 860 million subscriptions across all its services, up to 160 million year over year. This 860 million subscriptions will provide a stable but large source of revenue for the internet giant and can be leveraged into other services. Following this, we have Walmart, or WMT. Walmart has discount department stores, hypermarkets, and grocery stores worldwide. Walmart's 52-week low is 117.27 and its 52-week high is 160.77. Walmart's market worth is $360.73 billion. Its P/E ratio is 26.32 and its dividend is 1.7%. 5-year PEG ratio is 3.84 and the price to book is 4.77, 2.36% profit margin, and 16.2% return equity, 13.92 billion in cash, and 0.84 current ratios. Their dividend payout ratio is 4.4%, which is healthy. And the average analysis price target is $150.50, 15 more than the current price of $131.60. Inflation is an issue. Items are getting more expensive and spending will fall. Walmart didn't lower earnings forecasts owing to excess inventories like other retailers. Walmart has handled the problem well. Walmart users can earn greater discounts with Walmart Rewards during its inflationary period. Walmart is constantly building new stores despite the uncertain economy. Next, we have Procter & Gamble. Stock market ticker PG. This company makes family care, sanitary care, home care, and other household brands. Procter & Gamble's 52-week low is 129.50 and 52-week high is 165.35. They have a $340 billion market value, a P/E ratio of 24.49, and pay a 2.45 dividend. 5-year PEG ratio is 4.3 and the price to book is 7.61. The profit margin is 18.38 and the returns equity is 31.64. Last year, they had 80.19 billion in revenue, 7.21 billion in cash, and a 0.65 current ratio. The market is unpredictable. Investors tend to favor durable stocks over riskier growing businesses. Procter & Gamble is a large, enduring firm with a history of remarkable revenue growth. The Bank of America looks to be a good investment too. BAC is the ticker. One share of BAC is currently trading at $34.3 with a 52-week low of $29.67 and a 52-week high of 50.11. The last year's price chart shows considerable price drops. It's a fantastic moment to buy stocks. They have a $273.439 billion market cap, a P/E ratio of 10.63, and pay a 2.59 dividend. Profit margins are 30.69% and equity returns is 10.26%. The last 2 months' sales were $91.3 billion and $714.18 billion in cash. Analysts rate BAC as a buy with a price objective of $42.41. When the Fed tightens consumer spending, banks will suffer the most. People borrow money from banks, spend it, and repay it with interest. BAC's decline over the past year is due to this. Bank of America is positive for many reasons. Bank of America isn't the only struggling bank. JP Morgan Chase, Wells Fargo, and Citigroup have had terrible years. The drop in Bank of America's stock price isn't a reflection of the company's health, but of the difficult economic times we're in. Lastly, we have CSCO. CSCO is Cisco's ticker. Cisco is an American tech business that specializes in network, hardware, software, telecommunications, and other high-end tech products and services. Cisco's 52-week low is 40.82 and its 52-week high is 64.29. Cisco's market value is $190.2 billion. Its P/E ratio is 16.27 and its dividend yield is 3.19. 5-year PEG ratio is 2.18 and the price to book is 4.78. The profit margin is 22.91 and the return equity is 29.15. $19.27 billion in cash, 1.43 current ratio. 53.19 is a good dividend payout ratio. The company's revenue rose from $49.8 billion to $51.6 billion and its operating income from $12.8 billion to $14 billion. Cisco designs software and technology for computer jobs and projects. Overall, Cisco is a solid stock to hold because of its dividend payments and because it's a sturdy and trustworthy firm. If you're looking for a safer dividend option, I recommend searching Cisco. I realize that investing at the moment can be risky, given the state of the economy. But try to look at the broad picture and choose long-term investments in solid businesses. How do you feel? Do you agree with the stock advice? Please share your ideas in the comment section. Once again, this is Investors Facts, ensuring all your questions are answered. If you enjoy watching the video, kindly leave a like and subscribe. Until next time, cheers.